On the trader radar tonight, the Cheesecake Factory. The restaurant chain was among the most active names on the NASDAQ today.
Welcome back to Fast Money. We do have some breaking news, a statement out from the CIT group attacking basically Carl Icahn's representation of the company's prepackaged bankruptcy plan. In the statement that was just sent out by CIT, they're essentially saying that Mr. Icahn is misrepresenting their case for the prepackaged bankruptcy and that CIT is in fact offering $700 in new secured bonds for every $1,000 of existing bonds, in addition to an equity participation consideration, which would allow investors to participate in the upside. So essentially 70 cents on the dollar. What Mr. Icahn is offering through his plan is 60 cents on the dollar plus participation on the upside, which he values at 80 to 85 cents on the dollar. So CIT again issuing a statement in response to the flurry of news interviews that Mr. Icahn did, including one that he did first on CNBC on the halftime report today. I don't know if, Pete, you were on the other side of that when we were trading.
He made a compelling argument. I mean, the way it sounded, obviously this changes maybe some
But if it's 70 cents on the dollar.
Is it 70 cents of cash or 70 cents of new paper?
New secured bonds. It's new paper. $700 in new secured bonds for every $1,000 of existing bonds, in addition to equity, an equity consideration. And so the stakes are getting a little bit higher as we approach that deadline. We should know the deadline is Thursday, 11:59 p.m. Eastern Time. And so I'm sure there's a lot of phone calls going out right now. So again, the CIT group out with this statement in response to Carl Icahn's proposal. Meantime, let's move on to the next trade here. The dollar higher this week after hitting a 14-month low. That has caused a decline in gold and other metals. But our next guest remains the dollar's biggest doubter. He, of course, is Peter Schiff, author of the book Crash Proof 2.0, How to Profit from the Economic Collapse. He's also got a voodoo doll of George Washington himself, or a piñata of the greenback, which you wax every night. Take your pick. Peter, it is always a pleasure to have you with us.
Well, remember, I'm a big fan of George Washington because he hated paper money. He would not like the fact that his face is adorning the $1 bill. Because when they wrote the Constitution, they were hoping that there would be no paper money. But maybe the good news for George Washington is pretty soon we might have to phase out the $1 bill completely, because it won't be worth as much as it costs to print it. You know, we probably should put Bernie Madoff's face on there, though, for now, because it'd be a more accurate representation of the value of our money.
All right. Okay, so we clearly know how you feel. Peter, we have had a bounce in the dollar the past couple of sessions. Do you think that perhaps, even on a technical basis, that the short dollar trade may take a respite for some time right now?
No, I mean, the dollar index has moved up about a point from the low. And I guess if you're a day trader, it means something, but for everybody else, it's insignificant. The trends haven't changed. Nothing has changed. The fundamentals haven't changed. If anything, they continue to get worse day by day. So, I would continue to be out of U.S. dollars as I am. I would continue to be in the anti-dollar trades, gold, commodities, foreign stocks. Nothing moves in a straight line. The dollar is always going to have some rallies, but, don't be fooled by them.
Hey, Peter, how do you reconcile the fact that the Treasury bond auctions this week, we've had participation that's been almost 50% from foreign central banks and non-U.S. dealer players, indicating their interest in holding dollar securities? I mean, I agree with you, and we're probably on the same side of this dollar trade longer term, but I'm somewhat puzzled here. I'm curious your view.
Well, I don't think they really want to buy these bonds. I think they're doing it anyway because they're afraid of what might happen if they stop. But if you look at how they're buying, they're certainly concentrating their buying on the very short end of the curve, meaning they're really not married to these positions. They're not in 30-year bonds. They're in short-term maturities, which they can easily get out of when they mature if they simply don't roll them over. But I agree. It doesn't make any sense to me that anybody around the world is buying this debt. And one of these days, a light's going to go off in their head, and they're going to have an epiphany. And they're not going to be there to buy these bonds, and that's when we're really going to have to deal with a real crisis.
Well, Peter, it's Karen. If you were Bernanke, would you start raising rates now?
Well, if I were Bernanke, I never would have cut them.
Well, it is where it is.
I would be raising them, yes. I would be raising them. I would not be buying any of the paper that they're buying. I would be forcing our congressmen to cut government spending by not monetizing their deficits. And I would, bring back rational pricing. I mean, one of the biggest problems in our economy is that interest rates are too low. And we're not going to solve the problems until we have higher rates.
Peter, it's Joe. You still believe the equity markets is going down, the fundamentals of the economy are horrible, correct?
well, I believe the fundamentals of the economy are horrible, it doesn't necessarily mean that nominal stock prices will fall. I mean, if they print enough money, stock prices will keep rising. But it's not going to do us any good. I mean, look at the performance of the Zimbabwe stock exchange.
I know it's not going to do us any good. I'm just trying to break it down for a trade. If you look at the dollar right now, it's obviously a carry trade right now. So if they were to unwind the dollar based on horrific fundamentals in the economy, then equity valuations would go lower. So I think what I hear you saying is the equities market could keep going up. It's the dollar that's the actual trade.
Well, I think the dollar is going to lose value. That's what's happening. That's why it looks like stocks are going up, because you're valuing against debased money. But I don't necessarily think that dollar carry trade is going to get unwound. I think a lot of people look at the fact that in 2008, the dollar strengthened and markets declined, and people are afraid that, well, if markets decline, the dollar is going to strengthen again. I don't think that that's going to happen twice. I think it's more likely that the dollar will keep going down, and eventually it might be U.S. stocks that go down when they really appreciate what a weak dollar means for our economy, what it means for interest rates, what it means for inflation. I think right now people are in denial with respect to what the weak dollar actually means.
Okay, Peter, got to leave it there. You can go back to your George Washington shrine and go back to whacking your greenback piñata. Always a pleasure to speak.
Ben Bernanke's the one that's whacking it. You know, it's President Barack Obama who's whacking the dollar. I just understand what they're doing, and I don't want to get whacked, so I don't own dollars.
Okay, good point, Peter. Always a pleasure. Peter Schiff.
A lot of whacking going on.
I know.
A lot of whacking, yeah.